Hello, accounting students. Welcome back. This is lesson 2.2. Remember, we are working in chapter 2, and the primary purpose of chapter 2 is to make sure that we can analyze transactions into the debit and credit parts. We previously looked at how we use T accounts to accomplish this. We did that in lesson 1. So as we move forward into lesson 2, now we're going to be looking at the 4 questions that we're going to use to analyze transactions into their credit and debit parts. So this one is another one of those really important foundational ideas so that you can go ahead and put transactions where they belong within your accounting system. Okay? So first of all, one thing that you want to know is that every single business has a list of accounts that they use to post transactions to. This is called their chart of accounts, and every transaction changes the balances of at least 2 accounts. And going forward, you will see in the future that there are some transactions that will change the balance of more than 2 accounts, but you are looking at a change in balance of at least 2 accounts whenever you're analyzing your transactions. Okay. Here's an example of a chart of accounts. This is for Delgado Web Services. This, remember, is the business that we're using for the first unit in the book that is a proprietorship. So Delgado Web Services is a proprietorship, and we're looking at the chart of accounts. On the left, you're seeing the balance sheet accounts. On the right, over here, you're seeing the income statement accounts. When you're looking at the balance sheet accounts, the assets, the liabilities, the owner's equity, notice how they're numbered, and that when you have an account, the numbering distance between 2 accounts is by 10. This really helps because if you suddenly need to add another account, you have numbers available to you where potentially in this expense area, you could go ahead and add something maybe as a 545, and you would be able to slip it in right here in order. Okay, so that's really an important idea that you want to keep track of in terms of the chart of accounts and how these are named. Okay, so the next process then is to look through an actual transaction and to determine which 2 accounts are going to be impacted. And the easiest way to do this is to look at a T account for whatever accounts are going to be impacted by the transaction, and then determine, is the balance going up or down? So is it a credit or a debit? Okay, so on January 2, we received cash from the owner as an investment into the business. So as we're thinking about what accounts are going to be affected by this transaction, we could easily recognize cash as one of the accounts. Okay. The other one, we're getting money in from the owner, that's our clue. This would be Michael Delgado Capital. That's the other account. So the cash account, remember, we classify as in that asset. So a debit is going to increase and a credit is going to decrease on the asset side. So as we think about the cash is going to be increasing by $2,000, that's a debit. Okay, so we're going to be increasing or debiting cash. The second piece is that Michael Delgado Capital, this is an owner's equity account. So we are going to be increasing the owner's equity in the business. The owner has added money to the business. That constitutes an increase in their equity in the business. And so they're going to be a credit to Michael Delgado Capital because we want to increase. So we have a debit on cash and a credit on this Michael Delgado Capital account. Okay. Okay, so cash paid for supplies. Okay, so we paid cash for supplies. Well, let's just think through quickly the 2 accounts that are going to be impacted by this transaction, and immediately we're going to say, yep, cash, and then also our supplies account. So here we are looking at what's going on in the visual. So we create a T account for supplies and a T account for cash. Now, our supplies are increasing. Our cash is decreasing because we paid out cash for these supplies. And as we're looking at the T accounts, both cash and supplies are assets to the business. So an increase is going to be the debit, the decrease is going to be the credit. Okay, so supplies are debited or increased. Let's look at cash for insurance. We paid cash for insurance of $900. That's a hefty insurance bill. I sure hope none of you have to pay that much. So as we think about insurance, prepaid insurance for a business is an asset. Cash is an asset. So these are both on the left side of the accounting equation. So a debit is going to increase and a credit is going to decrease. As we're looking at this particular transaction, we know we're paying out cash. So cash has to be the account that we credit, and then we're going to go ahead and debit prepaid insurance. Okay, so now we purchased some supplies on account. On account is terminology that accountants use for I'm going to pay that sometime in the future. Anytime you see a transaction written as on account, no cash changed hands. So in this situation, you're not touching cash as one of your accounts. Okay, you bought supplies on account. So as we think through the two accounts that are going to be impacted by this transaction, we know that our supplies account is one of the accounts that's going to be impacted, but we also are going to have an accounts payable to Canon Office Supplies because that's a payable we're going to pay at some point in the future. As we're looking at this, the supplies account we already know is an asset. However, accounts payable, that's a liability. That's a debt that the business is going to have to pay at some point in the future. Remember, our supplies, an increase is a debit. It's on the asset side of the equation. Then the credit is actually going to increase the balance on the liabilities. So that makes sense for this transaction. We should see an increase in the amount of supplies. We should also see an increase in our accounts payable. We owe these people $220. That's more than the zero we owed them before. So now we are seeing a credit to increase on the liabilities. As we walk through, assets are increased, liabilities are increased. And remember that credit on the liability side is an increase. All right, we paid cash on the account. So now we are going to go ahead and envision a time in the future when we're actually going to send Canyon Office Supplies some money. Okay? So on the 9th of January, we sent them some cash for our account balance. We paid cash, so again, we know that cash is changing hands. Cash is one of the accounts that's going to be impacted. And then our accounts payable account for Canyon Office Supplies is also going to be impacted. One is an asset account, one is a liability account. Because we're decreasing our cash, we're going to credit cash for $100, and we are going to be decreasing the balance in our accounts payable account. That should make sense to us. We're sending them cash, and the accounts payable balance should go down by the amount of cash we sent them. Obviously, we owe Canyon Office Supplies less money than we did before we made this payment. All right, so the 4 questions that we need to use to analyze a transaction. What you want to be thinking about every single time you post a transaction or every single time that you create one of these. What accounts are affected? How is the account classified? Is it an asset, a liability, or owner's equity? How is the classification changed? So is it increasing? Is it decreasing? And then we want to be thinking through credit or debit, credit or debit. And this is the point where that little sticky note that we had you create that shows the accounting equation and the T accounts on both sides of the accounting equation can be really helpful in the learning process. So if you have not put together a sticky note that you can reference, I would encourage you to do that now. Which two accounts are affected when a business buys supplies on account? So as we think through the kinds of accounts that are impacted by this transaction, we know it's going to be supplies, but remember, on account means we're paying later. So that's always going to be an accounts payable classification. And in fact, we would see supplies and accounts payable here. Okay, so at this point, one of the things that I would like you to be thinking about as we really make sure that this information is settling in for us, think of a business that you might like to start or a business that you find interesting, and what types of transactions would actually be occurring within that business. So what is it that you think you might need for accounts, okay? And then in our minds, we probably want to start to think about, hey, we've got these prepaid accounts, like a prepaid insurance account. What other assets might a business have that they might prepay for? So as you're thinking through those ideas, make sure you reflect on the kinds of transactions that occur in a business and also some advantages of having assets that are prepaid. All right, at this point, you should head on out to Applia and complete the work together and on your own for lesson 2-2. And when you're done, you can move on to lesson 2-3. Good luck.